Every time the Federal Reserve gets a new chair, the same question shows up everywhere. Does this mean interest rates are about to change? And if you're involved in real estate at any level, that question feels more important. But the real answer is more nuanced than most headlines make it sound. Over the next few months, you're going to hear more conversations about the Federal Reserve, leadership changes, and what it might mean for interest rates. Instead of reacting to every update, I want to slow this down and walk through a few things. How a Fed chair actually influences rates, how does it not change quickly, and what people in real estate should really be paying attention to. Because misunderstanding this leads to bad timing decisions and unnecessary stress. I'm Corey Bonner. I work with people across the real estate industry. And my goal here is not to predict interest rates. It is to help you understand how the system actually works. You can make better decisions regardless of who's in that chair. Myth number 1, a new Fed chair immediately changes rates. This is the biggest misconception. A Fed chair does not walk into the job and just flip the switch. The Federal Reserve is a committee, not a personality. Interest rate decisions are made by the Federal Open Market Committee. Those decisions are based on data, debate, and consensus. Even when leadership changes, policy direction tends to move slowly and deliberately. That's by design. Myth number 2, markets wait for official decisions. Markets do not wait. Markets move on expectations, not announcements. By the time the rate changes actually happen, it often already is priced in. That's why you see mortgage rates move before the Fed makes a formal decision. It is why lending conditions can tighten or loosen with a headline. And it is why settlement in real estate shifts faster than policy ever does. Reacting late usually costs people money. Myth number 3, lower rates fix everything. Lower rates help. That part is true. But lower rates don't fix inventory constraints. They don't solve affordability gaps. They don't eliminate qualification issues. They don't replace good fundamentals. In real estate, rate relief improves conditions. It does not rescue weak decisions. People who wait for rates to save a deal usually end up waiting too long. What actually changes first? When conversations about Fed leadership start heating up, here's what usually changes first. Narratives shift. Optimism or caution spreads. Expectations change. Buyers and sellers adjust behavior. Credit standards move. Lenders reassess the risk. Transaction volume pauses or accelerates. Interest rates are often the last thing to move in a meaningful way. What real estate professionals should watch instead? Instead of obsessing over who sits in the Fed chair, focus on the signals that matter more. Watch lending behaviors. Are lenders easing or tightening? Watch buyer confidence. Are people re-engaging or staying cautious? Watch the deal structure. Are concessions shrinking or expanding? Watch time on market. That tells you more than forecasts ever will. These indicators give you clearer guidance than political headlines. So where do you go find these things? Write this down. Rewind this part or bookmark this video so you remember how to watch lending behavior. When reviewing the data, ask, are lenders easing or tightening their lending requirements? Pay attention to what banks and lenders are actually doing, not what they say on TV. Mortgage rate trend reports from Freddie Mac or Mortgage News Daily. Bank earning calls where they talk about credit standards. Commercial lenders changing loan terms, DSCR requirements, or reserve rules. When lenders loosen standards, activity will follow. When they tighten, deals slow fast. Second, watch buyer confidence. Ask yourself, as you review this information, are people re-engaging or just staying cautious? Confidence shows up before transactions do. Look at the Realtor Confidence Index. Look up pending sales reports, mortgage application volumes, showing activity, and open house traffic in your local market. If people are looking again, momentum is building. If they are still sitting out, rates alone aren't enough. Third, watch deal structure. Are concessions shrinking or expanding? This tells you who really has the leverage. So look at the seller concession in the MLS data or report sources from the MLS. Builder incentives like rate buydowns or closing costs. Well, just walk into your local home builder show and ask about their latest incentives on buying. Rent concessions in rental listings. You can find these just by hopping on Zillow. When concessions shrink, demand is firming. When they grow, pricing pressure is still there. Fourth, watch time on market. This tells you more than forecast ever will. This is one of the most honest indicators in real estate. Ask your local agent, what is the average days on market in your area? That's an easy one for them to pull. Notice the for sale houses on your street, how quickly or well-priced properties are going under contracts. Find out whether listings are being refreshed or reduced. Markets turn quietly first. Time on market shows before headlines do. Why this matters in 2026. The next phase of real estate market will reward perfect timing. It will reward patience, flexibility, and clear-eyed decision-making. People who understand how policy filters into real estate move earlier and more confident than those waiting for certainty. Now, the takeaway here. So, will a new Fed chair change interest rates? Eventually, maybe. Immediately, no. Real estate does not move on personalities. It moves on expectations, behavior, fundamentals. If you understand that, you do not need to react to every headline. You focus on making the best decisions in front of you. If this kind of practical, no hype market breakdown is useful to you, make sure you subscribe. We're going to keep unpacking what actually matters in real estate without the noise.